Rhonda Company had credit sales of 56,000. So what does credit sales mean?
Is it, I don't wanna, is it, I don't, is it counts like that have, like people that have to like pay us?
Yep. So it's
Okay.
accounts receivable.
Yeah,
This will have a beginning balance of 13,000 and an ending balance of 1,500. Compute its cash collections from its credit sales for the current period. So what it's technically asking you to do is saying, all right. We got a beginning balance, we have an ending balance, we did stuff in the middle, now what have people paid us back? So what do you think, what tool do you think I'm gonna be using? Take a wild guess. We take wrong answers here. Don't feel bad.
a ledger,
A ledger, a T-chart.
is that right?
Yep.
Oh. Okay,
So here we have our T-chart, we're gonna name it accounts receivable. And I'm gonna make this pen not so big. Perfect. So tell me, what is its beginning balance?
so accounts receivable had a beginning balance of 13,000 and an
Okay.
ending balance of 15,800.
See, I knew it was something in the past.
My bad.
No, you're all good, you're all good. I had a feeling, so it's 13 what?
1,000.
Just 13,000, got it? And what was the last one? 15?
Yeah, 850,800.
All right, now what happened between then?
It went up
It went up by how much?
2,800.
Something else, we're missing something here. There was something else that happens in between. How much credit sales did you do?
56.
56. So that happened in between.
Mhm.
So now, you're right though, we have to find the difference. We have to find X. So I'm gonna leave it, now that gave you the setup, I'm gonna leave the rest to you, okay?
Okay.
The journal entries are tough, but
Mhm.
I highly recommend if you have trouble with journal entries, take a screenshot of just the journal entries you've done
Mhm.
and practice reading them backwards.
Yeah.
I like to call, and you'll hear me say this a lot this semester, journal entries are the angry accountant's diary entry. Today I got cash for my account receivable. This much. If you think of it like that, it makes it fun.
Mm. It's just very meticulous with understanding, but like.
It is, it is so regard it's its own language, in
Mhm.
my opinion. It's like there is a very specific way to do things. There's specific,
Yes.
otherwise things get messed up, and because it's a math language,
Mhm.
if things don't equal up,
It's all
everything's-
wrong.
It's all
Yeah.
wrong.
I'm learning 2 languages this semester. I'm learning this and then business analytics or analysis.
That is its own language.
Yeah.
Is this supposed to be a big number?
I
don't.
Actually, let me do it too, just because that way I could double check you if I'm having to show you. So let's see. Can you tell me what you did? Like, explain to me your process, because from there, by itself, I can tell you.
So I added 13 and 56, like 1,000, and then I subtracted X, which equals 15,800.
And what is your number that you got?
53,200.
Perfect.
That's it. Okay. Okay. I'm just so used to like getting like small numbers sometimes.
You're good. No, it's good to double check yourself and kind of figure it out, but you have the whole process down right. We're trying to find your X. And this is basically every credit sale that gave us back money. This is everything that we found out, essentially, how much we were paid.
Oh, okay. So okay, yeah. So our accounts receivable, because our accounts receivable goes down 53,200, and only people owe us 15,800.
Yep.
Okay. Okay. Okay.
I love T-charts. No joke, they're your best friend for accounts.
Oh, also, about, I'm just confused on this part, where like the ADA, for like allowance for doubtful accounts, is it supposed to be like, debited? like it's normal down balance, or is the,
So its normal balance is a credit, but we debit it when we lower it. That's why, so if you were to put them in order like this, push accounts receivable, are you able to like, select it all and move it over? Try this way.
this?
Middle and right side, yeah. Circle accounts receivable. And just move it over to the right, yeah, there you go. There's your full journal entry, so it's normal balance, if you hide this, you credit it to increase it. And you debit it to lower it. Now, the reason why, is I see you're a little confused.
Hmm.
It is technically a contra asset account, which basically means it goes against our assets. Our assets increase with debits and decrease with credits. Our accounts, our allowance for doubtful accounts decreases our assets in total, because we don't believe we have that asset. It's still there, but we don't believe we have it, so we're making this little negative hidden in there to say, we don't think we have this much.
Okay.
So that's why we'll take this. We'll take this and kind of make a balance sheet out of it real quick, because visuals I think are always great. I'm a big proponent of visuals, so. We have our balance sheet here, we have our assets, our liabilities and equity.
Okay.
These are familiar, we're very happy with these.
Mhm.
So we have the cash. We have our supplies. We have accounts receivable, and then down here we have our allowance for doubtful accounts, and you'll see it specifically like this too on a balance sheet. Where it will be indented just a little underneath accounts receivable. And then we keep going, where we say, all right, equipment. We have. So on and so forth.
Yeah.
Now, if we were to make this even, I'm gonna make like an even balance sheet just to kind of look at. Accounts payable.
Cause debit, like, what is it called? Bad debit expense goes into the equity kind of part.
Yep. Bad debt expense goes here. So we'll say we're the beginning of a company, so we just began. Our cash is 1,000. Maybe 100 supplies. We have 31,000 accounts receivable. We don't think we're gonna get 3,000 of them. See there? Parentheses.
Oh, I remember she was telling us this, 3,000.
For 10,000. I'm gonna make this, because every balance sheet you always have to make equal. Always make your balance sheets equal. They're not equal. There's something wrong. All right, so that is 9. 3. 39,000. I'll now say.
I still understand this.
I'm glad.
So it's like she said, like if you had like 50,000. Like bad credit, not bad credit, but like if you had 50,000 like on credit, like people owe you. And like you expect like, let's say like 10,000, like you're not gonna get like 10,000 from those people.
Yeah, so we keep the whole number of our accounts receivable.
Okay.
Like, we don't change it, but we change it in detail. Like, this tiny little bit here is essentially saying, all right, here's, oh goodness gracious. I don't want that. I don't appreciate that very much. Oh, actually. Perfect. So we're essentially saying here. Perfect.
Okay.
We'll work with what we got.
Mhm.
So we're essentially saying here, all right, this total accounts receivable, that's the grand total, that will not change.
Uh-huh.
But that allowance for doubtful accounts says, well.
Most of it we won't get.
um, hopefully not most of it, like usually the percentiles are like small.
Okay.
So like maybe that grade is 10%, we don't think we're gonna get, that's still sometimes a lot, but at least it's not most. If you think most of them are not gonna pay you back, then why are you in business? So, if we were to see you're gonna look at something called net receivable, not net receivables. Or wait, yeah, net account receivables or net receivables. And that's essentially taking this information here and saying, okay, accounts receivable is 31,000. ADA is 30,000. Net AR is. So yeah,
So where does that go to?
that just goes to like financials, well, not financial statements, but this goes to the stockholders. This is information, like this isn't gonna go in our balance sheet, this isn't gonna go in our income statement and yada, yada, yada. But this is for information for us to determine, all right, are we good in business? Because just like you said, if a lot of it we're not expecting to see, we have to think from that perspective then, all right, should we be allowing these people to buy off of credit? Or should we be having them pay up front? It's a good way to kind of litmus test your customer base is to say, all right, do we need to put some restrictions? Do we need to do this or that? And even so too, it lets stockholders know, hey, how are you running your business? Are you not collecting enough? And if you think you're not gonna collect enough, then maybe I shouldn't be investing in you. As the opposite too, if you're, let's say the year keeps going by, we just got, because this stays the same until we write something off. We're not gonna be losing that ADA account until I say, okay, Billy Bob can't pay us. So we're changing this number and we're going to pretend that we managed to collect 30,000. Our network accounts receivable is now in a negative balance. Now, I don't think any company will ever get to this beautiful, beautiful standard, but you see now, this is a company I want to put stock in. They exceeded the amount that they were able to collect their money, more than they expected.
So this tells like, this basically tells other companies that if we're worth investing in. Okay, that makes sense.
Yeah, it's basic, a lot of financial accounting you'll realize is just figuring out the value of things. This shows us the value of our company in a way. But if honestly, chapter 7, if I can make things make sense, that makes me happy because this, no joke, I did not understand chapter 7 until I tutored it.
Dang.
And I'm glad now. I know it back and forth.
I'm gonna take a picture of that.
Yeah, go ahead.
Sorry.
No, don't be sorry at all. Please, please.
Okay.
It makes me happy when you guys want to take anything from here. Means I'm doing a good job. How are you holding up?
I'm good. The thing I struggle with is just like forming like balance sheets, income sheets. So I'm just trying to get practice right now.
Hey, any practice? If you ever want to, take the skeleton of this, not with all the accounts. If you ever want to just test yourself, especially figuring out what account goes to what.
Yeah,
Just take this little,
this L chart.
get an L chart with the ALE and try it out.
Gotcha.
Like, I honestly, I find that's like one of the best ways to kind of put it in, because,
Just figuring out what goes where.
Yep, and just doing that multiple times. Get a new sheet of paper, do it like once a day until you get it perfect.
Okay.
Do you know how Ms. Yeager makes her exams?
Yes, so they're gonna be part multiple choice and part written. So, and that's usually standard with most. I know Ms. Blockers is a whole lot more journal entry heavy.
Yeah, I assume so.
So, but with Miss Yeager's, you will have to do journal entries. I think she's changing up from last semester because it used to be mostly. They, well, I can't discuss too much, actually. I'm not gonna discuss too much, but. Practice how to set up, a balance sheet and financial statements like the income summary. I mean, the income statement, the statement of retained earnings. Understand how to. Kind of do transactional analysis, so know, okay, if I use up cash, my assets go down, but if I buy supplies, my assets go up, which means nothing changes in the value of things. And things, simple things like that, and just definitely knowing like some of the definitions and the principles. So the principles of like the revenue recognition principle, the expense matching principle, the
GAAP.
gap is something important too, but you just kind of need to know what it is, which is the general accepted accounting principles. So by now I just keep calling it gap, so I always forget like, okay, what does the acronym stand for? I know what it means.
Yeah.
If you write in shorthand and abbreviations, accounting's perfect for you. As well too, I do have things like, I have personalized blue kits for the principles, for classifications, for debits and credits. And such like that. If you guys want to practice anything, I could set that up here as well.
Yeah, I want to do that.
Can we do that? All right. Yes, of
So,
course.
like, unearned revenue is like, it's not revenue, but it's like.
You
when
haven't
someone-
provided the service.
Yeah, we haven't paid, like, we haven't done it yet, but they paid us in advance.
Yes.
Okay.
So
Because you'd be in debt to them because you still haven't performed the service.
Exactly.
Think of
And that's
it-
just money you can't really touch.
think of it too, you're liable because someone can sue you. So until you do that service, you're suable.
But it's more like a contract. If you put an annual contract, you have your lawn mowed, and it's only January, then it's still up until December that you're in the accounts payable.
Okay.
Was there any ones that you guys wanted to go over, or you think
Well,
you understand it?
I just need to know that expense means equity. Or it's not, yeah,
EE.
exactly. And then learning about like debt accounts helped me with like, what is debit, what is not a debit or credit.
So, are you a visual person?
Yes.
I'm gonna put this in a visual for you. Kind of help, because sometimes alliterations help people, sometimes weird puzzles help people. Let's move this along. We're gonna get the fancy smashy balance sheet. We're gonna ignore everything else though, but we're gonna be focusing specifically on equity, so. In a trial balance sheet, because technically you would not ever see equity expenses, or not equity expenses, revenues and dividends on a balance sheet. You'll never see those on there. So equity here, if you think about it, holds everything that you use in those financial statements. So we have our common stock, we have our retained earnings, if we have any. We have our revenue. We have our expenses. And then we have our dividends. Now, if we were to grab these two. Oh my goodness. If we were to grab those two, what did I just grab?
Revenue expenses.
Now, where do you see that?
Income, no.
Yes,
Okay.
income statement. Welcome in, welcome in. So you got your income statement here. Now, I'm going to take the oh, goodness gracious. Whoever messed with this last really liked bold print. All right, we're gonna take dividends and income statement. Or technically net income. So let me actually equals net slash income. Now, what did I just grab?
Not retained, or is that retained earnings?
That's your statement of retained earnings.
There we go.
So actually, you brought a point that I actually forgot to. Circle, so that's on me. I should have circled this retained earnings in this as well. And yeah, that's your statement of retained earnings. Which is basically brought out your retained earnings.
Mm-hmm.
And that does go on the balance sheet.
Yeah.
So if you could think of it kind of like this, where, okay, we have the income statement here, we have the statement of retained earnings, and expenses flows into the some way,
Yeah,
got your equity.
gotcha.
Yes.
So ending retained earnings going in.
Ending retained earnings, that's gonna be your new balance sheet balance for retained earnings. Because if you think about it, the statement of retained earnings is just updating it. We're basically saying, all right, this retained earnings is old. This was the retained earnings from last year. We need the retained earnings for this year. That's where you start doing these little financial statements to get to the balance sheet. Any other questions? Yeah, go ahead.
Yeah, do the same.
So what were y'all, what is this, about?
So this is trying to remember expenses are an equity. And it's kind of, it's a good little reminder of, all right. This is visually, this is our income statement, this is our statement of retained earnings, and this is what goes on the balance sheet.
Mhm.
Because if you think about it, revenue, expenses, and dividends, when you have your balance sheet, they absolutely disappear. They're gone off the face of the world.
Mhm.
Until they start up anew. The cycle continues. Now, does anybody have any questions on anything? Anything y'all wanna go over?
Besides like accounts payable, what are some other like liability examples?
So,
There's note payable.
note payable, so I'm gonna start writing these down.
Mhm.
So we got accounts payable, we got note payable. Not note receivable. Looks like it does not need a tail. All right,
Then there was the unearned revenue.
unearned revenue is a great one.
Wage payable.
Yeah.
Mm.
Those same.
Wage payable.
When did it start getting so full?
Literally like.
Yeah.
Minutes ago.
So, question y'all. Because we're starting to get a full house. Do you guys need me to try to see if we can snag a bigger room? How y'all feeling? We were on liabilities. Was there any other liabilities that we thought of?
Just
Interest payable? Or is that the same thing? as,
Interest
like-
payable is good.
so anything that says payable, just think liability. Gotcha.
So like a loan? Was,
A loan would technically be a notes payable.
okay,
Mhm.
You'd also have,
Because you're getting interest on it, right? Yep.
yep, bonds payable, like anything payable, honestly. So, I'm trying to think if there's any ones that aren't called a payable, but the only one that comes to mind is unearned revenue.
Mhm.
yeah,
And in all honesty, you're not gonna go that far ahead in this course to
Mhm.
need to know, any others than payables and unearned revenue.
Mhm. Gotcha.
Keep that in mind. Anything else? What is people have been struggling on?
7 apparently.
Seven?
Chapter 7.
Yes.
Chapter 7 is a beast.
can we do like examples?
Yeah, of course.
Yeah.
I love examples
Let me get ahead of my
Which
class.
one?
for like chapter 7.
Okay, great.
Yeah.
As long as it works with ADA, I'm happy.
Oh, yeah. So,
It's like you have $4,000 still, right?
Yeah.
But let's just say you think you're gonna not be able to get 1,000 of those, right?
yeah, we kind of went over like the basic concept of it, but we haven't done an actual problem. So one of the big things is, and we'll kind of, since we're gonna start with a basic understanding first. and build up from there because chapter 7 is, yes, it is an absolute pain. So we get a balance sheet out here. And to just kind of show up what it kind of looks like. I shortened a lot of stuff. If anyone has any questions on what any of this is, just let me know. So we'll say we're a new company. Say we start off with 1,000. Get to 31,000. What they are. 3,000. Allowance for doubtful accounts.
It's ADA.
Allowance for doubtful accounts.
Okay.
What's full supplies again?
Equipment.
Okay. I thought I read it flipped, I was like, wait a minute, what's this?
I have a question. What's a C, the, on equity, what's this, the first one?
Common stock.
Oh, okay, gotcha.
Let's see, did I do this right?
I'm trying to.
50,000.
Yeah, it's just.
Real quick, let me make sure the side balance is up before jumping into anything real quick. Writing it down because I might have to change something. So
All right, bounces up.
balances up. Make sure it always balances out for any balance sheet. Any good balance sheet worth its salt. Otherwise, you have issues. So
If you have to carry the debt over to the next year and then pay it in the following year.
So are we talking about allowance for doubtful accounts?
Yes.
Yes. So it's basically that account to say, hey, this is our allowance for considering what we're gonna expect to write off for the year. And that does sometimes carry. Depending on how much you've used, and you can, this is the one account that you can overuse. Like, obviously, you can't go negative in cash, you can't go negative in accounts receivable. Your allowance for doubtful accounts can have a debit balance or a credit balance. Its home is in the credit, but it can have a debit if you wrote off more than you expected. So don't let that limit you off.
And then just one more thing, what's BDE?
Bad debt expense,
Bad.
Where do you see that?
right down here.
And
Oh, I didn't even see that.
You're good, you're good. So some things to note. One thing. Allowance for doubtful accounts is under the assets. That's understood as a contra asset. And it's indented because it typically has a credit balance, which brings a negative to our assets. It lowers them.
because is it a write-off?
Not a write-off. It's specific, you can't technically write this off for the company or anything. This is just kind of a safety net. This is
Mhm.
this is us putting a safety net because under GAAP, the expense recognition principle states we have to expense in the time that we get, that we expect to expense. So the reason why the direct write-off method isn't GAAP approved is because if we have this timeline, here we did a service, we got our accounts receivable, so that's year 1, okay, year 2, year 3, they went bankrupt, so we write off. With the direct write-off method, you expense in this year. Which GAAP kind of shakes its finger and says, no. Now, under the allowance for the allowance for bad debt, we expense in this year, saying the year that we basically say, all right, we have this accounts receivable, we have this much accounts receivable, we expect to expense out X amount. In this example, I put, we expect to not see 3,000. So we do this in this year so that when we do write it off in the following years, it doesn't collide with our balance sheet. Not only that, but again, this technically lowers down our accounts receivable. If we were to look at our net accounts receivable, and our net accounts receivable is basically accounts receivable minus allowance for doubtful accounts, or plus if it's a debit. So if this was ever like 300, you would actually add it onto it. So we have allowance. The reason why we do this is specifically for the stockholders and for the managers that are kind of looking in and trying to see, okay, what's happening? Because let's say if our accounts receivable was maybe 1,000, a lot of people paid us off, but we haven't used this amount of money. People can see that we collected a whole lot more cash than we expected. In the opposite way as well, if we end up having like 400 accounts receivable and we expect to lose like 100,000 of it, a lot of these people are gonna look at us and think, why are we in business? If you're not in business to make money, why are you in business? So this is kind of just another reason why we do this is kind of to evaluate our business practice, because there's times where, okay, if we're expecting to lose so much or we're continuously losing this much, then maybe we need to start putting regulations on how we sell our product. We have to put a limit on credit and so on and so forth. So now that we kind of went over the background, let's move that aside. And I'm going to write a quick problem. And luckily for y'all will only ever have to worry about one method for this class. I had to learn 3. So you guys only have, huh?
Yeah, we're on the second one.
Yeah, you guys are learning, everyone's learning the accounts receivable method. There's technically 3, which is the credit sales, the accounts receivable, and the kind of the aging of accounts. But you guys just need to know the accounts receivable method. The accounts receivable method has a very specific way of doing things. So if you know the formula and the steps, you're golden. And up here, I'm gonna put up the accounts we use for every journal entry. All right. So the company has 40,000 sales on credit. It currently has a credit balance of allowance for doubtful accounts of 900. It expects to only collect 10% of accounts receivable. Does anyone want to try their hand at this, or do you guys want me to go one by one first? And all right, I'll do this step by step, and then I'll make another problem and have you guys tell me what to do. So step 1 is evaluate your accounts. We know our accounts receivable has, actually, I'm gonna put this in a different color. You know, step 1, our accounts receivable is 40,000. We know our ADA has a credit balance of 900. Something to note, always look at what this is, because sometimes it may say a debit. And if it says a debit, you just alter accordingly. So.
Oh, sorry, so if it's a debit, right, in that case, would it be like you just like taking money out from being, like, as a safety
So
net?
it means that we basically underestimated. It means that we wrote off a ton more than we expected. Technically, it's a bad thing because you typically want to have more left over in your credit than your debit. Let's say, and I'll show an example after this of what a debit kind of looks like, but we're just gonna keep going with credit since that's what is hopefully normal. So the other value you have to find is, okay, how much do we have to account for? So you take your accounts receivable and you actually times that by that percentile. So when we find that percentile amount, we immediately take that allowance for doubtful accounts again. We put a in value. You always write the dash there because you're gonna put this in value right here. And all you have to do is solve for X. After you solve for X, you do your journal entry, which basically makes that X into being. You can't have things happen in here without a journal entry to make them happen. So, and the cool thing too with these accounts in this way, if you memorize these accounts in this order, if you cover the bottom, the top is your adjusting entry. If you cover the top, the bottom is write-off. You cover the middle, here, this might actually look better anyway. If you cover the middle, that's your direct write-off method. Memorize them in that order, and that'll actually help out a lot when you start going through these. But we know that we are specifically going for. We're specifically going for this part here. We're saying, all right. We just want to adjust it. So we take our bad debt expense. This is step 4. Which is 3,100. And then we credit the ADA account for that amount. And in doing so, makes this a reality where our allowance for doubtful accounts becomes 4,000. Any questions on this at all?
That's it?
That's it.
That's easy. Okay.
I
It's-
thought the.
I thought it was way harder.
It's gets a bit complicated sometimes. So like, it seems easy at first, but you really need to get it to practice with it. Yes.
So if we didn't have it, it would leave a gap and there would be no way we could do checks and balances at the end of the quarter, end of the year, if we didn't have a stopgap just to dump it in.
Can you explain that a bit?
Okay,
So if we had like nothing in our allowance for doubtful accounts,
right. And we just showed a negative balance on something.
so we wouldn't be able to technically make a negative balance because we wouldn't be able to do a bad debt expense until you expense it. Whenever you do, like if you did the direct write-off method, this would be your accounts receivable, so it'd still balance out.
Oh, okay.
It's just that GAAP says, we don't want you to, because if you do that, then technically you're breaking our laws.
When breaking laws perfectly legal.
It,
Welcome to Texas.
welcome to the IRS.
So like, how did you get 3,100?
So it's because this 4,000, that's not our expense, that is specifically the ending balance. This is honestly where people tend to get confused the most, so that this is really like, if you repetitively do this, you'll do it right, because that 4,000 goes right at the bottom and you're just trying to find the middleman. So, for example, and actually this brings us to a really good example. Let's say if there was a debit there. So instead we're bringing this just a little down. And we say, all right, ADA 900. That ending balance, no matter what, goes here to 4,000. And we have to figure out how to get it to 4,000. So instead, that X would be 4,900. Now, is anybody confused why I got 4,900?
A little bit.
A little bit? So with these T charts, you only need one balance. Now, at the end of the day, to get over to here, I have to figure out how did I go from get from the left to the right. We have to make the left 0 before we get over to the right.
Are we estimating what we get, like our ADA?
We're estimating, but we're given the estimative percentile. So you'll always get a percentage. Like honestly, this right here, what I've made is the bare bones of the questions you're gonna get.
So like when it says it expects to only collect 10% of accounts receivable, that's when you should know it's like ADA. kind of?
Yep,
Okay.
Okay, so that's when it tells, that's when the question tells you that's your total ADA.
that's your total AD, that's your ending value. Yeah, no, if it says direct write-off method, it's only direct write-off method. You don't have to worry about any of this. You just basically say bad debt expense, accounts receivable,
Wait,
end of story.
So you're saying that's the write-off method?
No, this is the allowance method.
Okay, wait.
No, I was saying if it was the write-off method, you wouldn't be getting things like 10% of AR.
Okay. But we don't like that. Are we gonna be doing, oh, my bad.
You're good.
Oh, there you go.
Okay, is it, we're adding because it's debit that time, the 900? Okay.
So you have to just basically find a way, if I were to. For specifically, and this goes for any T chart at all. The only thing is with an allowance for doubtful accounts, we can have a starting point from debit or credit. But if we have 900 here, we have to first get 900 over here to cross it off before we could add that 4,000. Now, we can't just say that 900 never existed, so we have to add these together to say what the journal entry brings us to, which is, all right, we have to put $4,900 credit in there to get to 4,000. Does that help make sense?
Also, like for the write-off method, do you think we'll be doing that, like on the exam? Or is it just the allowance?
You might have one question that says, hey, this is a direct write-off method, just to show you what it is. But in all honesty, like this is the most of it. And a direct write-off question would technically just say, hey, the company had to something just simple like this where it says, hey, we had to write off something. It might have some more flavor to it, but essentially you have none of the bone structure that this question has. This question has the bone structure that you need to solve it for the allowance method, which are things such as, all right, we have this amount of sales on credits or allowance accounts receivable. You have already a credit balance for allowance for doubtful accounts. You will always get the beginning balance of allowance for doubtful accounts. And last is the percentile of accounts receivable. You'll get, okay, this is how much percentile we're expecting. This makes sense?
Okay, so we're expecting 4,000 that we're not gonna get back, or we're getting back.
We don't expect to get 4,000
Okay.
out of total. So that's why we're basically having this piggy bank and we're putting a specific number to it. We're saying, all right, 4,000 specifically. So sometimes that piggy bank already has some money in it, or that piggy bank might have an IOU in it. Just depends on the situation.
And that 3,100 is basically saying like.
We already had 900. So now we have to get 3,100 to make it 4,000.
So did we pay off that 900? Or
You
was
don't
it,
have
like-
to, basically that 900, that was left over from last year we expected.
Oh.
So it doesn't go away, your allowance for doubtful accounts doesn't go away, you just update it. So it's not a new account every year, it's basically, all right, at the end of the year, let's go forward, we'll say that 4,000 was for last year. Over the year, we had to write off $3,000, so we had to Oh, that is a terrible color to write on.
So you like increased your ADA.
We increased it. So
Okay.
that makes sense.
So is that like happen with, is that like real life, like, does that happen with most companies?
Yes, any huge company will always use the allowance method.
The 15th.
The 15th? All right. You might just, guys, be just a class behind, so you
Yeah.
guys will be at least ahead of your classmates.
Hopefully.
If it makes any sense, if anything, I've given.
I'm just trying to get definitions so I can be like, just understand like what bad debt expense and allowance of doubtful accounts is.
Cause this is like, honestly, it is the toughest chapter. It seems easy, but it is the toughest chapter.
Mhm.
But if you understand it so far, you guys are doing great.
Okay, so bad debt expense files to sum it up, is just like money that we're just not expecting to collect, it's
Yeah.
just not, we're just not gonna.
Now, that doesn't mean you don't collect it. That's why we have things like 900 left over in the credit account because we didn't collect it. Yes,
So is this for like everyone, like for all the accounts receivables?
yes.
Cause I know, cause like there's
We
like,
have the subsidiary accounts, which is basically when you break accounts receivable and say, okay, Bob owes us this much, Phil owes us this much. But that doesn't matter when we think of it as a whole. So with this, subsidiaries are out the window.
okay,
Yes.
No.
Oh, you don't understand what part?
I don't know.
So. Like I said, chapter 7 is a beast. Where, can you tell me where to begin, or do you just want me to run through it?
I just don't understand it. Yeah, sorry.
Let's start, alright.
I'm just, what question is this necessarily answering?
So the question this is answering is technically just, okay. Under GAAP principles. What do we expect to get back? That's like the bare bones of it, of our accounts too. Basically, everyone that has not taken money from us, but anyone who has bought off of credit or borrowed money from us. Out of total, this is how much we expect at the end of the day. And so let's say that my friends Bob, Phil, and Joe, I gave each of them $100 and I expect maybe 200 back. I'm just accounting for it this moment. Well, I don't expect to get 100 later. So. Does that help out?
I think so. Okay, so if you're only expecting to collect 10% of 40,000, and then you still have your 88,900 to account for if they don't pay for it, that's where 3,100 comes from.
Yep.
Okay.
That 31, it's basically, if you imagine it as like a piggy jar, that's from last year's savings. And so we just have to build back up.
Gotcha.
oh, so you just, what's the word? It's like, it's another word for like, like,
Yeah, we're just reimbursing. Is that the word?
no, this is
Refill.
another one.
Stop,
Restocking. Yeah, there you go.
Yeah, restock.
Okay, cause I was wondering, like, wait a minute, what does the 3,100 represent? And I was thinking of that for a second, but you just answered it.
Yep. All right.
This is like the
Just
basis of the homework.
This is basics of chapter 7. This is like the bare bones structure of it. Like the foundation. Now, is there any other questions so far on anything? This can go from
Okay.
chapter 1, 2, or 7.
Okay, so
Pretty good.
88 to start, okay, so 88 to start is just leftover from the last year, let's just say that.
Yep.
And then we're just restocking.
Yep, and then if it's a debit balance, it means we basically overtook. We put an IOU on our piggy bank and we have to pay back before we fill the piggy bank.
Ah,
Oh, wait, so we put an IOU in the piggy bank, so we need.
That's a debit.
so,
Y'all have a go?
so was that whole question like estimating how much we should refill?
Yes,
Oh, okay,
Okay.
that makes so much sense.
Okay, I get that, so.
and
so
then,
that's
yeah,
debit.
you have to make sure you have a journal entry too, to basically say you refilled it.
Okay, so the debit, so it's saying like, we put an IOU in. And we have
Yes.
to pay that back?
We have to get rid of that, of course, have a good one.
Oh, someone paid us an IOU and we're paying that
Well-
IOU back?
It means basically, let's say, we'll go again with last year. I expected 4,000. I expected to lose 4,000. Instead, I lost 4,900. So, yeah, so instead, of that 4,000 going away completely, we have to account for it in the debit. And the normal balance for an allowance for doubtful accounts is a credit, so we have to bring it back over. We have to say, all right, balance it out, and then get to 4,000.
Okay, so essentially went 900 over, which will be our debit.
Mhm.
So, but we have to make that a 4,000 credit to match the 4,000 from earlier, so we have
Yes.
to add that, okay, I get that.
Yes.
So okay, so what was the, from last year? What was the original ADA if we were like estimating?
So if we were to, it just depends on the accounts receivable. It changes every time because let's say last year we had 30,000 accounts receivables. But we still said, okay, 10% I don't expect to get. So now we make that 3,000. That's why we update it every year.
Okay. So like, is that, okay, I forgot my answer, my question. Is the, so is the 988 like leftover 88,
Yes.
like leftover from this, it was like, cause like, so most of it was paid towards paying off that bad debt expense.
So we're gonna keep going with this one. We'll say, all right, we had at the beginning. So real quick. So if you notice here, so this is where we write off. This is where you say, all right, we're taking out 3,000. Because that accounts receivable is gone. So we lowered our accounts receivable and we lowered our allowance for doubtful accounts because we see over here. So at the end, we only have 1,000 left.
Since we have,
Wait,
So this is through the year,
Subtitle?
because you only update this once every year. So this is where we write off, and this is why sometimes it lowers. And this is left over, so the next year we'll take a look at this whole equation
Is it-
again.
is that the ADA or is that the
oh,
accounts
wait.
receivable? Cause I wasn't sure.
A.
okay.
Cause I was like, hang on, wait, what is it?
Yeah.
Okay, so the 4,000 credit is gonna be our
Mhm.
amount that we put in there, and then the 3,000 in debit is what we used up, or is that what?
Yes, that's basically, over here saying those accounts receivable don't exist anymore, because if you remember, if we had,
Oh, we paid it off.
nope,
Oh, they paid us, sorry.
no, they didn't.
Oh, dang it.
Remember,
I
that's
messed
not cash.
All right,
That's saying, all right, 3,000 people, or not 3,000 people, $3,000 were lost to the wind.
Yeah, so our accounts receivable goes down.
right.
So, since our ADA, went down, right?
We don't refill it till the next year.
Yeah, and. Okay, so is that for one customer or is that for like,
It could be one customer, it could be 10 customers.
okay,
Let's just say-
The question will tell you exactly how much. Real quick, I'm gonna go ask them and see.
So that 4,000 in credit, that is what we start, that's what we
That's-
start the year with, right?
yeah,
The 3,000 in the debits is how much we end up using up.
yeah,
Okay, great, got it, awesome.
that's what I was thinking, yeah, I'm pretty sure that's what it is. If not, I'll just ask her,
That's what I'm thinking it is.
that's what I'm thinking too.
Hey, listen, if this goes horribly, I'm getting brownies to cope with this.
The only thing, I think the only thing I'm worried about is this.
Oh yeah, but you know, we gotta ask her, cause there might be a question on the test, right? Cause remember, were you there? Oh yeah, we're in the same group, right?
Uh-huh.
What's it called? Cause remember how she ended the class saying we had how to undo it? Cause I wanna ask her how we undo it, just so she can go through it again.
Oh, are you talking about the?
Cause if, let's just say, let's just say we wrote them off as not being able to pay,
Uh-huh.
but let's just say at the beginning of that next year, they end up paying us.
Oh, yeah, like.
So we have to,
this
so we have to fix it, yeah, that's not what I walked through that one time.
Reversing thing, I reverse the write-off, then collect the cash.
Yeah, that's what, that's,
Understood that part, it's just,
I need to get my notes out.
so that 3,000 is what we end up using up from the ADA?
Yep.
Okay, well then,
We're so good at this one.
yeah.
Yeah, it's good. Get it. It makes sense at the end of the day, but at the same time, it's
It's a painful process.
oh, this is my most hated chapter.
Why are we doing it like in the beginning?
Honestly, I'm glad because you get rid of it now.
And then it's all, okay, I keep saying it's all uphill from here, but uphill means that sucks. But it's essentially all downhill after this chapter, so it's like going down like an easier slope. Granted, there's probably gonna be some bumps in the road still, but it's definitely not gonna be as hard as chapter 7.
I'm just scared, like, did you take points off or did you just automatically just gets it like it's wrong?
She just usually takes points off. She's very forgiving in her grading process.
Let's go.
It wouldn't be right if we got most, like 90% of it correct. And then it was like, what do you mean you messed up this little part, failed?
No, just look at, I'm just gonna look at number, yeah, I'm just gonna go back to the last one we did, look, once, so.
You know, on
So-
homework.
Yeah, of course.
Okay, so-
Show me what you got.
So we have an immediate penalty, right?
basically, yeah.
And this is what.
So,
this
question.
update, okay, look.
What predicts
Yeah,
bad debt?
Yeah, it's like, this is.
Like
this is
what
This
predicts?
is based off, right, it's based off of something.
Mhm.
Okay, so we have an ADA 450, so that's gonna be amounts that would.
So,
yeah, oops, they're not-
Can you explain to me what the direct write-off method is?
AR is what the account.
Just off of your own
X, Y,
words,
Z
doesn't have to be
account
word for
is
word.
450. So let's just say,
I
so it gets back
I
next,
could
like next
actually
month, whatever.
explain the difference.
Okay.
So. if
So,
we reverse
The
it,
direct write-off method
got it.
is essentially just
Receivable.
right off the bat, we don't guess anything. It's just the moment they come in,
88.
cut them off. Now, the allowance method is, we are preparing first, we're making ourselves a little allowance for doubtful accounts for it.
Right, yeah.
This is.
And then,
back in
once
January.
people write off, then we're saying, all right, it goes down and down and down until it's
Yeah,
done.
it's a debit, this is a debit,
So-
that means you
Yeah.
take money out of it, okay.
And so
What do you think,
It'll be-
by hearing those definitions, which one do you think predicts bad debt?
Well, it sounds like allowance.
So this.
Perfect.
so
You're
this is
actually
Okay, so
making plans for in case they
Yeah.
don't, rather than just trying
So
to
why
cut
this
your
is them
losses.
giving
and
us
give
cash,
up.
so that gets rid of their.
So,
Yeah.
the
Okay,
one
got
that's
it.
not is correct.
Oh, let's go, I just this person,
Accounts receivable.
I just follow first, yeah, let me see.
Yeah.
She's
Just reported at net realizable value.
So, to get net realizable value,
And then
we're gonna
this happy
go
little.
all the way back over here. That's how we found our net.
Okay.
So, knowing how to get the net,
That's what I
you know
just said,
which one we're using.
The allowance.
Perfect.
Yeah, I was interested.
That's what I was gonna say, brothers. I'm gonna be honest. I'm not, I wouldn't. I would-
Right. Off
I was
specific
thinking-
account does not
I was
affect
doing
net
annual
income.
ranges.
Mhm.
Navy would probably be maybe like third
Well, cause Javin's in it because it's supposed to be easier.
So,
or easier.
Yeah.
the trick to this is,
Like, I have
it's good.
friends in the National Guard.
It's,
and
I'd have
in
to
the
go more
military.
into it, or you guys are probably gonna touch more onto it in class. But it's gonna be the allowance because we account for that bad debt first. So when we do get,
National.
whenever we do get write-offs, they're not affecting us. They don't affect our income statement at all. That bad debt is just chopped off at the beginning and done.
So direct write-off is just pretending it out, it doesn't exist.
It exists, but it's not allowed.
So the link.
It basically, it will affect the income statement when it happens, but
She has
the allowance account kind of keeps the income statement stable. Bad debt expense is not recorded until an account becomes a collectible. So that's basically saying you write it off when it happens. See. Real quick,
What's up?
because you guys might have a better way of explaining this than I do.
What's up?
What is it?
So, can you guys explain the allowance method?
The what?
Can you guys explain the allowance method? Since you guys seem to get it, I wanna see if maybe you guys have a different perspective.
Like,
That,
like for the problem that we just, like, the problem we just did?
Okay. Here's what I put, at least for that one.
Okay, so.
anything and everything.
So in a way, like the ADA, the allowance method, it's kind of like having like backup money.
It's backup money, but not having backup money. It's basically assuming for the worst.
Okay,
Because
yeah,
we
that's-
don't put money in it, it's just assuming.
Yeah. So it's, I don't know, it's like the way, like, are you talking about like the whole equation, like?
Yeah, what part of it? Like this, like, do you want us to explain the question we did? Cause like, just so we can be clear on this, does that? Cause if it's like, if we explain what the equation is, which is how we did that question. It's like how I would explain it. Cause if we're going off the question,
Or can we make a new question and then try
Yeah.
doing?
Yeah.
that?
let's do that, let's try to do a new question.
Let's do a question.
Our 62,000 will get on our debit side. And we'll write it there, and then our ADA. Our leftover ADA is 2,000, so since ADA is credit, we're gonna put it on your right side.
Perfect. You wanna write them all?
Oh, yeah.
It's on the board.
We have all
Oh
these.
my, I didn't even
Dude,
see
whoa,
these.
and it's magnetic. I thought it was like a clip or something you put it on. My mind was just blown just now.
We just have a ton of them.
That's the first step, right?
Yep, that's the first step.
Are you missing something?
No, basically it. It's just basically labeling, okay, this is where these go.
Yeah.
Now, you're gonna take a stab at step 2 and then you'll have 3 and 4?
Alright, that works for me.
Alright,
We're splitting up.
so basically, since you have a leftover ADA of 2,000, you're gonna multiply that by 0.8 or
Yeah.
your 8%,
So you got it wrong there.
0.08.
So what does it say? We believe we will not collect,
Oh, this is not?
not collect
Uh,
8%.
I mean,
Would it be 62,000 times 8?
Yep.
0.0?
Perfect.
oh.
Do you want me to do this? I got my calculator pulled up.
Yeah,
Teamwork.
I can't really do that.
It's 8%, right?
It's 8%.
0.08.
49,600.
Okay. 3.
Oh no, that means I'm up, doesn't it?
Yeah.
Yep. Real quick,
So
though,
when this is not,
you forgot to bring a 0 over, so it's 4,206.
4,000,
Wait, 60, yeah, 4,960,
What?
because 8% of 62,000.
8% 62,000. So you do 62,000 times 0.08, right?
0.0.
Yeah, 0.08.
Yeah, you multiply that.
That much
0.8.
wrong, maybe?
108.
Yeah, you multiplied it to be around 80%.
Oh, yeah.
My bad. I must put wrong.
Yeah, there's a eraser.
Oh yeah, we have another pen. I forgot.
Yeah, there's plenty of pens. We
No,
got
my
like
bad.
so many.
That sounds like a typical mistake I made. Okay, so
Oh. We're
4,200 or 960?
that's okay. So it's just gonna be 4,960 for because all we gotta do is just move it one decimal. Yes, one decimal less will be 4,960.
So that's perfect now. All right, now,
No, you're trusting me with this. Oh,
Yep,
you guys
three.
made a mistake.
So if this is not collect 8% from accounts receivable, we're multiplying that by the from the total credit sales?
yes, so it's always gonna be times the total credit sales. So that's your, credit sales is your, I keep wanting to say allowance receivables, accounts receivables.
Yeah.
Well, it just says we believe we will not collect 8% of our accounts receivable.
Oh, and the last question said ADA.
Nope, they both said accounts receivables. You'll only ever get it from accounts receivables.
Yep. All right, time to, we'll figure something out.
I believe in you.
All right.
So what are you gonna do with that number?
Okay, so this is gonna end up, okay, I'm just gonna write first, because it's just easier to write first, so it's gonna be an ADA account. And then we're gonna make a T chart and just bring over 2,000. Okay, so now now we just found our total that we were gonna need for this year. So it's gonna be 4,960. Okay, we'll pretend that one looks like a 499.
This board is hard to write on.
Yep. All right, so now we just gotta subtract 4,900, 2,000 for 4. We guys just gotta subtract this, right?
Perfect.
All right, and that's just gonna give us X equals 2,960. And, oh yeah, okay, now we gotta make a journal entry, which I hate. Okay, so it's gonna be it's bad debt expense.
Perfect.
Okay, it's bad debt expense. And that's gonna be our debit. So it's gonna be 2,960. Because this increases with debits and yeah, fun. And 88 is gonna be our credit. And just 2,960 to balance it.
Perfect.
Wait, what's 4,960? What's that? Okay, yeah.
Sorry, bad handwriting.
No, that's perfect. Now, what would you do if I said that we had to write off $500?
Where?
I just said, I'm sorry. We lost, our customer went bankrupt, so that $500 we're not collecting. What's gonna be the
Wait,
journal
we can't
entry?
we can't.
Oh, I know that one.
No, because we want it to be filled with this amount.
Okay.
It already has that 2,000 in there. We have to add 2,960 more into it. Does that hold up?
I mean, I didn't know that was not, but.
To be fair though, it's this, it's apparently ours chapter, so we.
I mean, I know where the numbers are coming from, but
Yeah.
why?
Because we want to get to this total. And we want it to be the total in our allowance receivable accounts. So that in the end, when we see our balance sheet. We see our balance sheet, we have our cash, we have our accounts receivable, we have our ADA,
So step two.
and over in our ADA, we have
So it's
4,960 in the total.
My bad.
Before it had only
Times
2,000,
0.08.
but now it has 4,960. So we had to find that middleman of
Three.
2,960
Sorry, slow.
to get to that.
Good. And then your eggs, you're basically solving for, like, in a way, you're doing like this. Oh,
You're doing
Over
subtraction.
here. Yeah.
Essentially, step three is like a glorified subtraction
you'd be
problem.
doing this, like, so you're finding X, you're doing 2,000. What is that for?
Yeah, 4,960.
You're basically doing a formula. And so you subtract this side.
Oh, wait, you're subtracting it by 2,000.
Oh, my bad, the other way around.
Yeah, the boards are slow. Yeah, give them a minute.
And then you get X, and then you get this whole thing.
Okay.
Does that help out?
So what is 2,960?
It's just your leftover ADA, like it's.
2,960.
My bad, that's. Like,
It's how much you need to fill. It's like filling in 2,000 to start off with. So how do you get to 4,960? You just got.
this just means you're restocking this, your ADA, so that you can have that left, like, not leftover, but like. Your back, like, not backup money, but like, just money that you can eventually, have in case,
I think we should move on to something else for a minute, just to let this sit in,
I just,
and it'll come back to it.
I don't understand why,
Why? What?
Why we do all of this?
essentially.
It's honestly the best the best answer I could give to that is because of GAAP regulations. It's due to the GAAP regulations of the expense principle.
When that.
is it like to avoid fraud?
In a sense, yes, is it to avoid a sense of fraud, but also to kind of, it's expense recognition principle. It actually helps businesses, especially bigger businesses, have their net income not affected. So if we look over, and we're gonna go over here to
It's like when you said, is that company worth investing in?
it, this is one part of it, but there's also another part. Basically, because our net is this, let's say. Whenever we start actually writing off things, that's not ever going to touch our bad debt expense except that one moment in time. After that, our bad debt expense is set, so our income statement here will never change. This will change. This will change up and down, however it needs to be, but your income statement won't ever change. And so in a way, it creates stability for a company. If that makes sense.
Yeah.
So it is GAAP regulations, but it's useful on both sides if used correctly. So for the allowance method, what's the journal entry to write off?
For the allowance method?
Yes,
What's the journal entry?
yes,
Wait, write off what again?
to write off the, write off.
Like we wrote off $500.
Yeah, if we write
It's
off,
gonna be ADA being a debit, and then your AR is a credit.
perfect.
Yes.
We're just writing these down. Yeah,
Debit.
debit credits.
Oh, by the way, it doesn't matter how far, as long as I signify that there's an indention
Yeah.
and fine print.
As long as it's clear there's an indentation, I usually go with at least the first two letters.
Oh, I kinda do like, I do like half the word.
Oh, that's
Oh,
perfect
yeah,
too.
I make sure I put like a big indentation to
Hey.
overemphasize it.
You wanna know what? You're not gonna ever miss points on the test for mistakes on thinking that they're both debits. Yeah, no,
I
you,
do.
you can never like. Obviously, if it's something like,
I do 88 and then I start where the A is at the end of 88.
I've
or-
done that
or-
before too.
Or I pretty much at the end of the first is when I start my next one.
Alright. So we paid employees wages for 1,500.
Okay, so that's gonna be cash account,
Cash with debit or credit?
credits.
Alright, perfect.
And it was that we paid their wages?
Yes.
Yeah,
Wages.
See, I'm not like fast, so I gotta like read that sentence carefully.
yeah, I have to work through it slow, otherwise, if it's like something I don't know immediately or something I have to hesitate on, I have to take my time on it, otherwise I miss it.
So, what about if we performed a job for a customer for a fee of 900, but we have not been paid yet?
Okay, so it's gonna be accounts receivable,
Yeah.
Debit or credit?
debit,
And we
Mm.
have a revenue.
yes, right?
Yeah, right?
Yep.
Yeah, cause
We did it.
we performed the job.
So now, what if that accounts receivable is paid off?
Okay, so it's gonna be,
And
wait, hang on. Okay, our cash goes up,
No,
right?
ADA would be if
We wrote if,
we wrote it off.
oh, okay, my bad.
so it's gonna be cash going up because they paid us.
Oh, yeah, okay.
Now, let's say we bought equipment on credit,
We bought equipment on,
Payable.
debit or credit?
credit.
Credit,
And then our equipment will go up as a debit.
yeah, cause we own it.
Equipment's different, it's weird, cause, don't we have to do something else for equipment?
Later on in chapter 8, we do depreciation, but you don't have to worry about it till then.
Okay,
For right now, you just need to know that equipment is an asset.
alrighty.
Later on, we'll start getting into the nitty gritty of it, but that's later.
I like to put my problems off to later, that's why it causes me some.
I'm getting better at this, I'm just happy about it.
Let's do supplies. We had to throw away part of our supplies.
Okay, so, wait, okay, so it's gonna be supplies and supplies expense. right?
Perfect. What way?
Wait, what was
Okay.
the question?
So
Okay,
we had to throw
so,
away supplies. We used up supplies.
okay, so it's gonna be like supplies is gonna be credit and then supplies expenses is debit.
Perfect. Now, let's say if you were given a question where it said, all right, at the beginning of the year, we had $5,000 of supplies. At the end of the year, we only had 2,000. How much would you put into, what number would you put into that?
Okay, so so it's 5,000 what we started with, right?
Yep.
And we end with 2,000? So that means our supplies expense can be 3,000.
Perfect. Is there any questions on any of this so far?
Could you go that one again?
Yeah.
So, I'm gonna write the question down along with it, so we have a question on it.
Yes, I'm gonna cut this one.
If I see it, I can go back to this.
It's a, this one's weird. I feel like that's just a really good one. for me.
So what would be a good way to kind of put this into a visual?
And let me copy this.
Ledger?
A ledger.
Ledger's also a T account, right?
Yeah, the same difference. A ledger is usually just like a whole thing of T charts.
So it's an asset, right? We had, at the start, we had $5,000, so that would go on the left.
And then, so our expense would
At the end, you put, okay, so you put the line thingy where, cause it says end balance.
Yeah, and then we gotta put 2,000,
Yeah,
sorry,
like
3,000.
debit, yeah. And so you, to find the rest,
You
you
have to
have
do
to
it.
like get the X, like, yeah. Yeah.
There we go.
And so since we have 3,000 for our credit, that's why, where we get 3,000 for there.
That does.
And so in that question, is supplies expense always gonna be the same as supplies? Or is it
Yes.
just, okay, so it's always the same for this?
Yeah, for this, if it's ever, hey, you're lowering your supplies, you're gonna have supplies expense.
Okay, so if it's a question like this, they'll always be the same for those two?
Yep.
Okay, that's great to know. Send me some time.
I'm not.
Oh, yeah, I got a copy of that.
We're just gonna move it over a little bit.
Benefits of having a smartwatch.
I know.
ADA standard.
Allowance for doubtful accounts.
Yeah.
Allowance for doubtful accounts. I'll write it down.
I'm just gonna write off to the side, always the same. Please. So same. I feel like I'm aggressive with these pens sometimes, when I just click no like that.
So, what if the owner invests $2,000 into the company?
Common stock.
Yippers
In
and
cash.
cash.
So it look like this.
Yippers. And what's it called? Common stock's part of contributed capital, right?
Perfect. And what's earned capital?
Wait, earned capital?
Equity.
Not equity. Equity is contributed capital and earned capital.
Okay, what is it? What do you say?
What is earned capital?
Earned capital is, I wanna say stuff, I feel like it'd be revenue, but I don't think it's revenue.
A part of it's revenue. Think of on the balance sheet, not on the trial balance.
It's not retained earnings.
Yes, it is.
Oh, it is?
Yeah. Retained earnings, earned capital.
Oh, yeah. Yeah, can you, I need to math this out in my head, even though it's not math, hold up, it's not adding up.
Well, think of it, your revenue, your expenses, and your dividends, everything that kind of goes away goes right into retained earnings. And those are the earnings that you retain. Because you retain those earnings, that's your earned capital.
Oh, okay, that adds up actually.
Is that on the formula?
That's gonna be your income statement, then your statement of retained earnings, and then going into your balance sheet, because if you think about it, that whole process is updating your retained earnings.
Which is your retained capital.
You have your earned capital.
Sorry, it's earned capital, I was
And-
wondering.
If, as long as you know one or the other, retained or earned becomes retained earnings, you're good. Though I think you're gonna be asked something more along the lines in chapter 11, when we start diving into common stock and preferred stock and all that.
Let's go, we're ahead.
So do we have to worry about that for the first exam?
No.
You might, well, I don't think so. I don't think it's gonna be that nitty gritty for retained earnings yet, so no.
Okay,
That's just fun facts.
I didn't know that.
I'm gonna assume the first exam is gonna be just like pretty much what we're doing in here.
Yeah, it's a lot of the basics. It's where you're learning, okay, what's gonna be debits, what's gonna be credits. It's going to be knowing the accounts. It's going to be knowing some terminology like what an account is, what a ledger is, what are assets, liabilities, and equity. The accounting formula is a big one, and knowing how to kind of set up an income statement or statement of retained earnings and a balance sheet, and doing basic journal entries. It's also gonna be dealing with some things on chapter 7, though more likely it's just gonna be how to set up the formula and how to do the journal entries. I think the most it might ask is like, okay, subsidiary accounts.
Okay, so
Separate.
subsidiaries like the little ones that make up the big one.
Yep. And net receivables.
Net receivables is gonna be,
Are you
it's
talking
like,
For net receivables, what's more?
it's like your 80.
No, accounts receivable minus 80?
Perfect.
Yes,
Okay, yeah.
I knew it was the thing we went over today, I just
Yeah.
couldn't remember.
And you guys have 2 more class periods with chapter 7 too, so
I'm not gonna worry too much about it since we have like, I'm not gonna worry until like maybe like Monday. like after Monday when we're doing this, if I still don't understand it, like, good, then I might wait a little. I'm not gonna like pull my hair out at this point.
All right, let's keep doing journal entries.
Yeah.
So we borrowed $5,000 from the local bank.
So it's gonna be a note
Oh,
payable,
Yeah.
note payable.
Credit or debit,
Okay,
Credit.
credit,
and then what else?
would it be cash?
We can
Yeah.
do that.
Yeah, oh yeah, cause you're giving you cash.
Yeah, they're giving us cash. It's basically when you take a loan from the bank.
You get cash,
Do they-
but it's also just a formal loan.
Okay, never mind.
It does. The thing about notes, it's that loan, it's where you start getting interest expense and all that fun stuff.
It's the formal version of accounts payable, right?
It's the formal version tied with interest.
Okay.
Accounts payable, you typically don't have interest until later, yes.
So is like the notes payable like, or it's like, is it like not mainly, but is it like banks?
Yes, mostly banks, or if you ever, it will state, rather, if you ever see bank, you borrow money from the bank, that's a note. Or if you ever just do something off of a note. So a note payable is specifically like a very fancy sheet of paper that says you pay the whole here. You're paying this amount of interest for this amount of days for that total amount. And we start getting into the real nitty gritty of that for chapter 9 and 10. Oh yeah, no, you're gonna love amortization charts.
So what?
Is this, or is that?
Honestly, I actually do enjoy amortization charts.
Amortization chart.
Yes,
So is it easy?
it's easy once you learn how to sum them up. So it's not, the cool thing about this is that every problem is the same. You will, for allowance question, you'll always be given your percent, you'll always be given your allowance for doubtful accounts, and you'll always be given your accounts receivable. One last thing real quick.
Givers.
We have, if it looks like a credit, I mean, if it was a debit, so let's pretend that this question said it had a debit for 1,230. All you would have to do, put it onto the debit side,
And then you just have to essentially, all you gotta do is just, wait, wouldn't you just add what's it called? You all just have to add the total and then you just gotta add the 1,230, that's your answer.
you do have, yeah, you basically have to add them together. So the reason why, and to kind of visualize it, you need to put 1,230 here to cross it off and have 6,820 left over. So the total for that would be 508. So you'd have to put in a total of 8,050, and that would be this instead of 4,590. So if it ever gives you a debit on this side for the beginning account, this is just how to reverse engineer it to get your answer.
Where'd you get the 850?
Added 1,230 plus 6,820.
Oh.
So I'll have to end it there. I have to run to a Zoom meeting.
Oh, that's gonna be fun.
Of course.